The first thing I want to go over in this class is, one, I'm not a financial advisor. This is not financial advice. This is for entertainment purposes only. Okay, I gotta say the disclaimer. The first thing I want to go over is what's a basic market structure shit. And it's imperative to go over this right now because you guys are gonna need to know what to look for in the chart, and I'm gonna show you like the difference between a good one, bad one compared to like an inverse. Okay, so the first 5 minutes are gonna be a little basic, I know, just bear with me. Okay, so again, the classic 2022 model is pretty straightforward. Okay, there's some institutional sell side level here. Okay, so let's say this is a sell side level, or it's a higher time frame PD array. Okay, and basically what higher time frame PD array means, for anyone not wondering, is like a fair value gap in the higher time frame. So if we go to like the daily, okay, a higher time frame PD array would be something like this right here. Let's mark this daily fair value gap. Okay, and then you go on the 5 minute, and this line is your higher time frame PD array. Okay, so that's what a higher time frame PD array is. All right, so now that we have that, just gonna go back to this. Okay, now that we have that, the basic 2022 model. Okay, pretty straightforward. Here's sell side / higher time frame PD array. Okay, barely. I know this is basic. And the 2022 model is something like this. Okay, where we kind of come down, we bearish order flow, come down like this, and then we hit this level. Okay, so this is not a support level. Okay, this is not a support level. Okay, everyone type 1 if you understand. This is not support. This is not a support level. Like, this is not a line you just randomly draw. Okay, this is real support. This has to be a fair value gap. Okay, it has to be a fair value gap, or it has to be low that we go under. It is not a support level. I'm not just drawing out. You can't just look at the chart in hindsight and be like, oh, this is support. Okay, we all understand that. All right, glad we all understand that. Great. Okay, so when I draw a line that says it has to be a higher time frame PD array, that's exactly what I mean. Okay, it has to be like a fair value gap. It has to be some sort of sell side level. Okay. So now that we know that, okay, let me go back. The 2022 model is this, right? We go hit this level, okay, and generally before we hit the level, okay, we put in a lower high. Okay, this is the important part. And I'm actually going to show you a couple different scenarios here. Okay, there's multiple. So this is actually a little more advanced. Okay, so you're going to like what I'm about to say. Okay, and I don't talk about this a lot. A lot of people get confused with this. Okay, this is the normal 2022 model, right? Something like this. Let's put this a little lower. Okay. With a fair value gap right here. Okay, so what would you rate this setup? What would you rate this setup right here if you saw this in live time? Yeah, okay, exactly. It's the fire setup. It's a probably pretty good buy. Okay, I would rate this an A setup, right? So it's important to understand that. All right, so here's where the 2022 model can change, and this is where a lot of new people, which can get really confused. What happens if we get a 2022 model, but it looks like this instead? What if it looks like this instead? What would you rate this setup? Yeah, exactly. So this, yes, I am uploading this. This would be more of like a B setup, because what's the difference? Someone tell me the difference between the setups. Yeah, and this would be a 50-50 setup. This would be more of a chance to be a 50-50. What was the difference? It's not that there is no market structure shift, okay? Because when you guys say market structure shift, I say a market structure shift is fake, okay? When I label market structure shift on the chart, okay, and I go down here, and I'm labeling market structure shift, do the market algos know this is a market structure shift, break of structure, whatever it may be called? Like the market makers or whatever, the algorithm, whatever, does not know that this is a market structure shift. What really is this? What's really a market structure shift? Like if you add science behind a market structure shift, what really is it? It's displacement over a high, and what happens when you displace over all the highs and lows? What happens? What's the whole market move on? Yes, exactly. Stop losses. It's all stop losses. So when I say market structure shift, you got to realize the market structure, it's really not like I'm labeling it as a market structure shift, but the market doesn't actually know this. All the market sees here is stop losses. It does not see, oh, this is market structure changing. Okay? So when I say that, that's also imperative to understand. Okay? And when we sweep like a higher low, okay, a market structure shift is based off of two things: the displacement we get over it, and whether we create a fair value gap. Okay. Well, let's say you see this happen. Okay, so now that we understand that, okay, we know that this is not as good of a setup as this would be right here. Okay, and we understand that because there's stops getting ran here. Okay, but this is also a worse setup because, and it has to do with stop losses. Okay, let's say you guys are a big hedge fund or something like that. All right, let's say you're running a million, billion, trillion dollar hedge fund, and you could pay back the U.S. debt, but you don't want to because you want to trade NQ instead. Okay, let's say you want to trade NQ instead of paying back debt for U.S. All right. Okay, so if you were a hedge fund and you were in a short position here, okay, and you were in a short position here, do you think you would reverse your position if you saw something like this? Do you think you'd reverse your position if you were short? Let's say you're short here. Do you think you'd reverse it to be long here if you saw something like this? Exactly. You'd probably hold because this doesn't really tell you that we're going to reverse yet, does it? So this is why this is a B setup, because does it really look like we're running any old stops over here? Like, and does it really look like we're displacing over this high? Not really. Okay, now let's say you're a hedge fund with $1 trillion. Okay, let's say you saw something like this. Would you be more willing to reverse your position and try to get to, like, would you be more willing to reverse your position in a situation like this than the first situation? Yes, exactly. Okay, does everyone understand why you'd be more willing to reverse your position in here? Yes, this could be a breaker. It doesn't have to, but. So, again, we'd all be more willing to really just change your position if we saw this versus if we saw the first scenario I just showed. Okay? If this is a fair value gap. Okay? Okay, and that's a really important thing to understand, because a lot of you new guys taking this 2022 model, you'll see something like this. We won't really make an obvious lower low, or lower high, I mean, and you'll just blindly buy some 50-50 setup that doesn't really even run anything. Okay, it doesn't really run anything, and you'll see some fair value gap to hit sell side, and this is what you guys do, okay? And half the time it works, half the time it fails. You just never know. So, again, the first thing I want to start off by saying is, if you are new and you are looking at this 2022 ICT model, make sure there's always some obvious lower high put in before you actually take it, because this setup right here is not as good, because we're not really displacing over any stop losses to make sure, like, oh, if a hedge fund was short here, we're not really displacing over anything to make them want to reverse their position. Okay, maybe now we would. So maybe now, if like the market did this, this would be your entry. But you don't know that until it happens. Okay, and this is kind of the second entry right here. Okay, like a market maker buy model. This is the second accumulation entry, which is my favorite entry. Okay, I don't like taking these. I like taking these. Okay, but hopefully you guys understand that, because that is a big lesson in this bigger lesson I'm about to show you guys. Okay. So does everyone understand kind of the beginning of what I just explained? Not everyone has to type yes, but as long as the majority type yes. Okay. So everyone understands what I just taught with how the 2022 model works and why people it fails for some people, because they'll take a setup like this instead of waiting for like an actual obvious lower high to be put in, which would be better. Okay, so this is worse. This right here is much better. Okay, and I will make a visual on this at some point. Alright, so now let's go over kind of the inverses versus market structure shift, okay? Because this is what the class I want to be about. Alright, so using what I just showed you guys, okay, using what I just showed you guys, let me find some examples on a chart. Okay, so I'm not going to be going over the inverses yet, okay, but right here, okay, you clearly see right here, lots of displacement, a very clear market structure shift, and at the same time, this bearish fair value gap is getting broken. So would you guys consider this an A+ market structure shift? If you were a hedge fund, would you want to go long after displacement like this? Yes. Okay. If you're answering no, then you're wrong. Okay. The answer is yes. Beautiful. Okay. This is more of a break of structure, though. But again, when I refer to break of structure, market structure shift, that's just the terminology. There's not a correct terminology for this. Some people say this is a market structure shift. Some people say this is a break of structure. Okay. If we're trying to be all technical, I would label this as a break of structure, because we were already bullish, right? We're already bullish. Okay, so, but in this situation, it's imperative to know that, okay, this is a lot of displacement. If you were a hedge fund and you were short, I totally try to reverse my position here. And what these hedge funds try to do is they'll see this and they'll still be short, and using all their money they have, they'll keep shorting, and they'll make the market go down themselves, and they'll make themselves get out of break even somewhere down here. Okay, so like they have so much money where they can move the market back down here and get out for break even, so they don't take a loss in the first place. Okay, but would they really want to do that if we didn't displace that hard? Not really, because if we only displaced up to here and then went back down, they would probably have the ability to keep going down lower than their position if they wanted to. But this is so much displacement where they're not going to fight all these other banks, institutional funds going long here, okay? They're not going to try to fight these guys, right? And all the algorithms, okay? The market is not based off of buyers and sellers. If you don't already know that, it's all based off of algorithms. And, I mean, giant banks, institutions, they role play too, obviously. It's all their algorithms buying. It's not the actual bank. It's all their algorithms. But they're not going to try out to fight all these banks' algorithms trying to buy back here, because there's just so much displacement where there's going to be a lot of leftover orders, okay? So in this situation, okay, here's your shift. Okay, so much displacement is causing these guys to reverse the position. And if they were short from this candle, right, you can see how big of a candle this is, right? A retail trader is not making this candle, and this is probably a big seller, right? It's a giant institution, a bunch of algorithms selling here. So when that gets reversed, they're kind of looking to bring it back down, and you can see they eventually do bring it back down right here. And I bet you a lot of them who sorted here got out right here, okay, for break even, because that's what they do. Okay, so that's the first thing. Okay, but why do I like inversions better than market structure shifts? Okay, the reason why I like inversions better than market structure shifts is two things. Okay, let's say right here, for example, do you see how big, or actually no, I'll just use this example again. Do you see how, like, we know that no retail trader is making a candle like this? They have to have a lot of money to make a candle like this. Well, if I see this and it creates an inefficiency at the market, meaning there's a lot of orders here and it creates that inefficiency. If I see this and I see that reversed, that gives me more confidence that, okay, this guy, whoever made this candle, is definitely going to reverse their position. Okay, and that's why I like inverses so much, because if you don't understand like the market, you need to understand it to trade it. And when I used to use indicators, I never used to understand, okay, why does the market do this because of this? But based off of this, when I see this inefficiency right here and this reverse, that tells me something. That actually tells me that someone who just made this red candle is going to get wrecked. They're all going to get stopped, or they're going to have to reverse their position, and it'd just be a better market structure shift for me. So this is a market structure shift. Does everyone understand it? Does everyone understand that this is this is also a market structure shift? Okay, good. So this is a market structure shift. For anyone confused, an inverse is a market structure shift. And for this one, there's actually no entry. There's no entry. I'm not gonna say to enter because this is hindsight. Okay, if I was live trading this, I probably would have market bought anyways off this close. But this just kind of confirms bias. Okay, but basically, this guy or whoever sold here, maybe it was your grandma, I don't know. Maybe your grandma sold here and created a fair value gap for the market. Whoever this was for this candle getting created, okay, whoever this was, you know they have to reverse their position or somehow get it back down to break even. Okay, so you know why this is a good market structure shift. Versus if we go like, let's say, if we go like right here, okay, see right here, see how right here we make like we also have displacement right here. Okay, see this right here. Okay, but was there ever an inverse fair value gap? Was there ever a bearish fair value gap in this leg that we inversed? Okay, there was not. Okay, see how in this situation, see how we had displacement over high, which should represent a break of structure to bring us up the buy side. But do you see how there's actually never like a big seller here that got reversed? Right? There's no bearish inefficiency here that got reversed. Okay, so like if we were to compare the win rate of something like this, displacement over some random high, to tell us that we're going to go hit buy side, the reason why I don't like this and why I don't like this fair value gap to long, okay, is because why? Someone tell me why I don't like this fair value gap to long even though it looks like a textbook displacement. Okay, why is this not a good fair value gap to long even though there's a lot of displacement over a really obvious high? Based on what I just talked about. Yes, there's no inverse fair value gap. Okay, but someone explain why not having an inverse fair value gap here means we're not going to get to this high. Why does not having yes, exactly. So plus EV gets it. So there's not really any institutional traders or institutional algorithms, whatever you want to call them, okay? I don't really care what you call them at this point. You can call them the Megatron 3000s. I don't really care, okay? You can call them whatever you want. There's nothing that has to be reversed here, okay? So there's no really inefficiency here, okay? That's saying, okay, the market wants to reverse these and wants to go back to the high. All you see here is just a run on these stop losses, and we do get a lot of displacement over it. And would you arguably say, okay, this is a variation of the 2022 model right here? Market structure shift, obvious high above, fair value gap discount. Would you arguably say this is some of the 2022 model here? Yes or no? Yes, okay, so this is a good variation of the 2022 model, okay? We have bullish order flow. Okay, the only thing wrong with this is we never really took any low here, but we had displacement, we had an obvious wick high, okay, which was a projection block, which I'm not going to talk about, but anyways, this is like the type of trades when new ICT traders will take because they'll say, oh, this is a market structure shift. Very vacuum discount. But the only problem with this one, and okay, I will be straight up with this. Do you think if this exact setup happened tomorrow, Tuesday, Wednesday, Thursday, Friday, do you think if this exact setup, how we just set up right now, if this happened 10 more times, do you think it would work on any of those setups? Yes, okay, it would. I guarantee you, if we got something like this again, I guarantee you this setup would work at least 5 of those 10 times. Okay, because this is a good 2022 model, and it is one of those fair value gaps where, yes, this will work sometimes, and sometimes it won't, like this. Okay, now let's say there's an inverse here. Okay, let's say there's some giant, and by the way, you're probably wondering why I'm not talking about this inverse over here. Okay, why do you think I'm not saying anything about this inverse right here? Yeah, we already kind of used it, and it's a different leg. Okay, because this is a different leg, I don't really like it. Since this leg, we made a new leg, which was this high to this high, so this is the whole new leg. So this is the leg where I want the inverse, because this is a whole new leg. This is kind of an old leg. Okay, so I don't really care about this anymore. Okay, but anyways, let's say there's some big giant candle here with a bearish fair value gap. Okay, let's visualize and pretend it was right here, even though it's not really there. And let's move over here. Okay, now let's say this setup with the inverse and the market structure shift, let's say this played out 10 times. How many of those 10 times do you think it would work? Yeah, I would say out of 10 times, I'd say it'd work 8, 9, or 10. Okay, yeah, 7, 8, 9, or 10. However, if this was not here, like how we see it right now, this setup is probably going to work like 5 of those times. Okay, I don't really find these setups good because there's no seller that's getting reversed. There's no institutional buyer that really has to reverse their position here. Okay, if this is a hedge fund or some institutional bank shorting here, okay, they shouldn't be worried when they see something like this, because there's no other seller here. They're not really getting reversed. Okay, so again, does everyone understand the difference between, okay, here's a normal microstructure set 2022 model, and then that may work 5, 6 other times, but then here's another inverse, giant seller, ton of displacement going through on the same leg. This is going to work 7 or 8 times. Does everyone understand why? Does everyone get that, just to be clear? Yes or no? Okay. Roger Dodger. All right, perfect. So that's what I'm really trying to show you guys. Okay, and after this class, okay, you might say, oh, I'm still taking the 22 model. I don't care about inverses, whatever it may be. Okay, but this is kind of to show you that an inverse is going to be 10 times better than just a market structure shift here. Okay, and I'm going to go over a few more examples. Okay. I would love to use, okay, right here. So right here, okay, this is a very good one as well. Okay. We got a very obvious low. Would everyone agree this is a very obvious low and very obvious sell side right here? Yes. Okay, this is very obvious. Okay, now look what happens. Okay, look what happens very, very closely. And there are multiple explanations for this, but I'm going to explain it one way. So we took sell side. Would you guys agree that this is a market structure shift in the 2022 model after taking sell side? Yes, 100%. We took sell side, or we purged sell side, should I say. Okay, took sell side is not really the proper term. We purged sell side. Okay, why do you guys think this failed right here? There's actually, so this is an interesting setup because it works, but the 5-minute market structure shift doesn't work. Okay, and I'll show you in a second. Okay, no one's probably going to get this because I'm going to have to kind of talk through this a little bit. Okay, yeah, higher time frame was probably still bearish. Obviously, that's always the obvious reason. Okay, the obvious time frame is, oh, higher time frame was bearish, but you can't just say because it play failed that the higher time frame was bearish, because I would, if it was me, do you guys think I could have made money in this setup if it was me? Yes, I would 100% made money in this. This would not have been a loss for me. Okay, but for some of you guys taking the 2022 model, this would have been a loss. Okay. So why would I have taken a win on this, but some people would take a loss? Okay, I would take a win on this. 2 reasons. I see the high. I see the last lower high up here. It's very obvious. But I also see a giant wick. Okay. 1 green candle here. 1 green candle here inversing this. And then another green candle right here inversing this. And in this example, whenever I talk about inversions, I only like when there's 1 inversion. In this case, there's 2. Even in this case, now that there's 2, okay, I'll wait for the top one to be inversed, because that tells me, because the reason why I do that is because let's say this was inversed and I long this, well, there's still a possibility to reject from this. So I kind of wait for the, if there is 2, which I don't like trading when there's 2, I'll wait for the top one. Okay, but if I saw this candle close right here, I would have longed right here. Okay, and for you guys in my premium who watch my live streams every single day that you watch me live trade, how would I have traded this? So I would have longed right here, as you guys know, because it's an inversion. How would I have played that? So I would have broke even on internal liquidity, and exactly, and I would have taken some partials on this candle. Okay, and I probably would have market sold. So for me, okay, for someone who's a little more seasoned, and I'll take the classic 2022 model because a lot of it's, I feel like the 2022 model lags sometimes. See how this kind of lags and it ends up being a fail versus you could have gotten in early before the model forms. So right here, I would have longed the inverse instead of actually waiting for the true market structure shift, because when you see this, this is a market structure shift. There's 2 giant red candles here, and they're both getting reversed. Okay, what does that mean? That probably means whoever sold here is probably going to try to reverse their position, at least get us back to the next high. Okay, so an example like this, I would have longed this, and I would have done this. I would have scaled half here, or I don't even know. I probably would have scaled like 25%. The next bottom looking to scale is some sort of inefficiency. So I bet you there's some 15-minute fair value gap right here. Okay, I'm not going to go in the higher time frame and look because it's going to waste time. But I bet you this is some 15-minute fair value gap. Okay, there's no way I'm wrong. Okay, I would have scaled like another half here, and then I'm holding the rest till some high, and I probably would have done it to like this high at least. Okay, so for me, I would have longed here, scaled half here, scaled another 25%, whatever it may be here. Okay, I don't know what I would have scaled a live time. I'm not going to pretend like I would have scaled whatever in hindsight. Okay, but that's how I would have played it. And when we hit this high, what do I do? How do I trade when we hit this high? The next high after the inverse. Yeah, I put my stop to break even. So how I trade is once we hit the next internal high, which would be this, I just put my stop to break even after I scale, because it's now a winning trade. And some of you may not like this explanation, but you can see my bias in the end. Let's say I thought we were going to go to this high. My bias would have been wrong, okay? And I actually may have taken this play. I don't really remember. I might have taken this play, okay? But based on how the market moves, once you see this inverse, okay, like this inverse right here, we have to hit the high. Okay, we have to. We just have to. I can't explain why, but we have to. So if I know we have to, and I put my stop to break even, I'm totally safe, because chances are if we hit the high and then come back down and violate this fair value gap, okay, we're like the majority of the time from my backtest sessions, okay, I'll explain what the stop will be in a second. the majority of the time for my backtesting sessions is if we hit an internal high, which I know we have to hit an internal high after the inverse works. If we come back down to my entry, I would say 70% of the time we dump way farther. Okay, versus if I didn't move my stop loss to break even here, okay, which I'll explain where I would have had my stop in a second. If I didn't move my stop to break even here, I would have gotten stopped out anyways. So let me review how I would have played this, okay? So I'm buying this candle, okay, we get a close over, and you can do one or two things here. You could buy them, or you can market buy here, which I'm going to do for this situation, or you could buy the next candle right here. Okay, so I'll just pretend I bought that candle too because it was the inverse. And what I'm doing, and let's say I bought 3. What I'm doing is my average is now right here. Where's my stop loss? So Mohammed, I'm teaching you guys. You don't need displacement, or you don't need a market structure chip for an inverse or a red gap to work. I'm basically showing you that this is a market structure shift. Okay, this is the market structure shift. These candles are the market structure shift. Okay, it's not this high that's going to be the market structure shift. It's these candles, because there's 2 giant institutional sells here that are totally getting reversed. So when you see that, they're at least going to reverse the position to the next high. Like the algorithm or whatever, I can't explain it yet, okay? ICT probably has no good explanation for this yet, but like there's something else going on that it's unexplainable, okay? Where we have to hit the next high for some reason. It's something that I've learned after this inverse is reversed, okay? So my stop loss for this would be, okay, right, but tell me when the last example was and I'll go over it again. Okay, stop loss for this would be, I would enter here, okay, but my stop loss would be closed under this fair value gap. Why would it be closed under this fair value gap but not a close under this one? Does anyone know? Can I even put a stop loss? No, I can't. Let's just put my stop loss right here. So why would my stop loss been here? Yeah, because we had 2 inverses. Okay, if this wasn't an inverse, where my stop loss would be up here. So do you see why I hate taking these 2 consecutive fair value gap setups? Because this stop loss is now almost negative risk to reward. Okay, because it's so low at this point. So that's kind of the reason why I don't like putting it before, or that's the reason why I don't like to take two inverse fair value gaps, because the risk to reward is kind of bad. But yeah, the stop loss would have to be under here because that's just how the market works. And if my stop loss is under here, that's how it has to work, because that's how the market moves. If I'm right, the market, there's no way it's going to close back under here. Okay, but this is a key example of why I actually don't take setups where 2 inverse fair value gaps, because the risk to reward is just is horrible. Okay, but for the sake of this example, this is how you trade it. Okay. Because there's 2 instead of 1. Okay, but let's say the inverse fair value gap's right here. Okay, which it isn't, which this would have been a better setup if it was for me because of risk reward, but my stop would have been under here. Okay. Anyways, what would I do now? So now I'm targeting this first high, and ICT sets limits. I actually teach people in my live stream to market sell sometimes, because sometimes we'll get like a candle like this, and you can get a few extra points. And I know it's kind of cheeky, but especially if you can stay in the screen and watch, you can get a few extra points if you kind of wait for the break and market sell rather than just set a limit here. If you have to go AFK, it's obviously better to set a limit, but you can get a few extra points and up your risk reward just a little more if you wait for the break and market sell. Anyways, right there, I'm selling 1, okay, because at this point, I know, based off of this inverse setup, I know the market at least had to hit this high, even if I'm wrong. Okay, if I'm in a long position here thinking we have to go to this high, okay, and I'm wrong, I at least know the market has to hit this. Like, it just has to. I can't explain why. Like I said, it just has to. Based off my screen time and based off these getting inverse, it just has to hit this high. So that's why I'm always scaling one, and that's why whenever we get there, I'm always moving my stop to break even. Okay, so now my stop will go to break even because 60% of the time we come back down to my break even stop in this situation from what I back tested. 60% of the time we'll go back down way below here. So it's better if I'm moving myself to break even than to let myself get stopped out way down here. And at this point it's a free trade, which is why my win rate's so high. Okay. Yes, and plus EV says there's also a fractal market short shift in the inside bar. So again, the reason why this is so good, because whenever you see something like this happen where just a series of fair value gaps are totally inverse, the market at least always has to go to the next high. It doesn't even have to go up here, but you at least know it's going to go up to here, okay? 99% of the time it will go back to that high. Okay, and that's just how the market moves. It's unexplainable to me yet. Okay, it's just because if these guys were reversing the position, that doesn't mean we have to hit this high, but we just do, and that's what I've learned off screen time. Okay, like I said, there's not really a good explanation for why, but that's why using inverses are so good for scalps, because, and why my win rate's so high using them, because I use that kind of idea that I know we have to go to the next high after something gets inversed. I use that idea, and that's why my win rate's so high. And a lot of people think if I have a 100% win rate, all my full price targets are hitting. Okay, that is not the case. In this situation, if I thought this line was going to hit, I'll still have a win. This trade will still be a win. I'll still have a 100% win rate, even if this high doesn't hit, because I'm still taking off here. I'm still taking off in the next bearish inefficiency in case I'm wrong. And then I'm getting stopped to break even. Okay, the full price target is not even hitting, and I'm still winning this trade. Okay, and that's why my win rate's so high. It's literally probably sitting like 85% right now in the last month. Okay, which is very, very extremely good. I know one person on Twitter with a higher win rate, but my win rate's still pretty good. And we kind of trade similarly. So again, this is how I trade. I'm not holding the full position to this high. Okay, now there are probably some risk reward traders in here who only put their take profit and only put their stop losses and don't touch it, and they just get in the trade. Okay, and that's a whole different way of trading than what I do. Okay, so if you are a risk reward trader and do that, don't change anything. But this is why my win rate's so high, and why, yes, I do care about risk reward somewhat. But if you can have a higher enough win rate and know in a situation like this that we have to hit the next high, then risk reward doesn't really matter here, because I'll gladly market buy this and leave my stop down here on a funded, because if I'm live and I'm seeing the setup during the day, like, I'm almost so confident we go to this high just because I've seen it so many times. So even with a negative RR, I still know it's going to be a win. And again, some people don't like that, but just from me watching this market every day, I know it has to happen. I know there's 9 times out of 10 it's going to work, and that would still be profitable even with a 1 loss. Okay, so again, that's how the market works, okay? And that's why I kind of do that. So in this situation, okay, I'm scaling another one here. And then at this point, okay, I'm not scaling another one because I think we're going to hit this high. My stop's now at break even, and I just have an order sitting down here at break even. I just let the trade do its thing, because in this situation, if we come down to my break even stop, which this is a whole nother explanation, where would we be delivering from if right now we came down to my break-even stop, okay? If we came down to my break-even stop right here, okay, you're listening? Where would we be delivering from? Yeah, exactly. So if we're delivering, right, if we're delivering from a bearish fair value gap down to my break-even stop, what do you think's going to happen? Yeah, exactly. We'll probably expand further because we're delivering from a bearish PD array. Yeah, it means you're probably fucked, okay? So do you get why I move my stop to break even after we hit some higher time frame PD array? Because if I'm wrong and we reject that higher time frame PD array, okay, I know I'm probably going to get stopped anyways. Does that make sense? Type 1 if that makes sense. Okay. And again, I'm just explaining, I'm just trading how the market moves. Okay, this is literally just how the market moves. ICT explains why it does that. Okay, from watching his videos, I've noticed some gaps in his explanation, which he cannot explain either. But it's just, it's how it works. Okay. So again, my stop's not break even. I get stopped there. So let's say I get stopped break even there. And you can see just we're delivering from a bearish ED array, and it ends up stopping eventually anyways, and it ends up hitting this low. Okay, so that's kind of a walkthrough for my strategy and how I trade. Okay, like this is literally how I trade, and this is why my win rate's so high. Okay, and you guys saw the video of the eval account I passed. Okay, $2,000. I showed the P&L and I showed the win rate. Okay, you saw that on Twitter. Okay, I uploaded it like a week ago. Okay, and you saw out of the, I think it was actually 18 or 17 trades total. It said 21, but it was, if you know anything about that, it's actually like some of that, they'll count double your trade for doing something. Okay, if you saw that, you can see that's literally how I traded the eval account. I just did stuff like this where we inverse something, we didn't even get the market structure shift, and I just sell some at this high, sell some here, and I just hold the stop break even. Okay, that's literally how I traded the whole eval account. I didn't take any order block. I didn't take, that's literally what I did just for that eval account. And that's why, like my funded account, which is up 1,000 right now, okay, one of my funded's up 1,000 right now, I'll take loss on that because I'll take other models. I'll take order blocks. I'll take other fair value gaps that aren't inverses. Okay, but the win rate's not 100% on those. Okay, and I'll do that because a lot of things. There's outside factors. Maybe I can't trade during a time, and maybe I want to test the setup, whatever it may be. Okay, but if you can stick to this, and maybe you only want to master this model, I think it. I'm not gonna lie. My most important ICT concepts explained in only 20 minutes. About 5 minutes at is kind of wrong. I was really dumb in that video. That was a really old video. I have not watched that, but you can if you want. So anyways, do you understand my strategy? Type 1 if you kind of understand how I trade based off of that kind of recap. Okay, beautiful. Do you want me to go over one more example? Okay, I'll go over one more example real quick. I thought because fair value, sorry, I can't, the chat's going way too fast. I can barely read any of it. I thought iFVG formed because big traders are trying to, you don't see, would be scared of PA if they're short initially. In the situation Bell posted, they wouldn't. They just, in the situation Bell posted, okay. So I'll just go over this real quick. In the situation he posted, there's no, like this, we can call this the big institutional seller. Is this getting reversed? Nope. Okay, so is anything going to make them reverse their position? Nope. Even though there's an order block sitting right here. Okay, there's an order block sitting right here. Okay, this, and some people, noob traders, might be like, oh, we just hit sell side. We just hit sell side here. We just got an order block. Is this truly bullish until this is inverse? No, because even though there's a bullish order block, it's not going to scare these guys out, and because they're still going to be in profit in their position, right? They're not going to be a drawdown while they want to get out. The only way they're getting out is if we have a huge candle close above this. And when we get that huge candle close above, I know I don't have volume in my chart, but when you get that huge candle close above, okay, let's say, let me try to find a good example. Like this, let's say this. So this is a very good day. We can't see the volume on the chart, but you can tell this candle just has a lot of volume, okay? And this is why VPA traders can be good traders too, because they'll see all this volume kind of violate. They don't know this is the fair value gap, but they'll see all this volume come in, after this bearish price movement, and they'll see that's probably all these getting reversed and people are getting out and scared out of shorts, right? And that's even without volume, you can kind of tell just off the candle. Okay, you can tell off the candle. So that's why I look for that. Okay. Bullish TV model. Let me check. Yes, that is exactly right. And I want to make a visual that goes over that. Yes, that's perfectly right. Good job. And GDT, and for all you guys terminology experts, okay, you're probably not hearing me say BPR versus inverse. Okay, I'm using them kind of interchangeably. Okay, this is actually a BPR. Okay, not really an inverse because it's a bearish or rally gap that was now traded right through the bullish one. Okay, with nothing in between. So this is a balanced price range. I just use them interchangeably. I don't want to confuse people, and this is always going to be the stronger one. Okay, the BPR. An inverse would be, there's an inverse example from Friday. An inverse would be this right here. So an inverse would be like this because we kind of filled it already. So see how like right here we filled it. Okay, but then we close under, so now it's an inverse rather than a BPR. Okay, hopefully that makes sense. But I kind of refer to them the same thing. I could use them exactly how they were taught, but I'm teaching a model. I'm not teaching a dictionary. Okay, this is not an English class. This is a model. Okay. So no, Aiden, it's not. Okay, see how this is already filled right here? And then we close under, versus if we just close under without filling this, or without bouncing off it, it would have been a BPR. Okay, it's not easy to understand, but that's why I don't use them. That's why I don't like say them interchangeably. Okay, like this would also be an inverse. Okay, this would be an inverse because we don't get a bullish rally gap here, but we do violate this. Oh, yes, the BPR would be right here then. So this would be the BPR. Okay, but this up here would be the inverse. Right here. Okay, so like right here, you can see this would be the inverse and not a BPR because there's no bullish rally gap here, is there? But does this still work? So again, even in this example right here, okay, here's another inverse. Do you guys see any key market structure shifts here? No, the time frame does not matter. You could do this on the 5-second. Do you see any good market structure shift here? Yes or no? Yeah, exactly. Okay, pretty obvious answer. You don't have to say no because you probably already know that. But there's no really the last higher. Okay, where would you say the last obvious lower high was put in? I'm gonna go slowly. Look at the time. So you're gonna tell me the time. Where's the most obvious last lower high? Not the last swing low or the swing high, but the last obvious swing high. Yeah, exactly. 1504. Okay. I know this is a swing high as well. Okay. This is a swing high because there's a high, higher high, and lower high. But do you see how if you like back away from your chart, you could actually see this and you probably won't be able to notice this one? Yeah, exactly. So there's not really a shift because if we really look at it scientifically, this is the last swing high. This is the last obvious swing high. Do we ever really shift over these with a lot of displacement? No, we do not. Okay, we never actually shift with these with a lot of displacement. Okay, but in this situation, okay, us using the inverse model, this is my entry right here. Okay, these down in this zone. Okay, I'll probably just mark it by when we kind of get into it. Okay, but in this situation right here, you can see it's another example where there's no market structure shift, but there's an inverse. And I'm targeting the high that, so here, tell me if this makes sense. I'm targeting the high that traders are waiting to be their market structure shift. So do you see why I win more? Because I'm targeting that high that traders are like, oh, this could be a market structure shift. And if it is a quote-unquote market structure shift, which is a retail concept, by the way, okay, that is taught to retail traders early on, okay, the trend and how to identify a trend. This is taught to retail traders. If I'm sitting there waiting and I'm new to the market and I just watched a video by Carmelo, Renata, whatever his name is, I don't even know, and he says, oh, if we break a last lower high, you long. If I'm sitting there waiting for that and I'm waiting for us to displace above this high, I'm like, oh, finally, we got above the high. That's great. Now I can go long. And then you get wrecked. Meanwhile, I'm already long down from this inverse, okay, and these traders who are going long here are already getting wrecked, and I'm already long from down here. So do you get why I like using inverses way, way more? Okay, and that's really the other big part of it, because like even as a trader who's just coming to the market learning, oh, price action, this is how we should go. If we make higher lows and higher highs, we should be going up. Those guys waiting for that higher high to be made, they're the ones getting wrecked when I'm already in from way down below at the inverse, when these big guys selling are already getting reversed. Okay, so that's the other reason why I like this. So does that make sense to everyone? Okay, and that's why I don't really like the 2022 model, like initially, because that's the big, there's a big discrepancy with that and how ICT explains it. ICT explains it well, and he explains how he should be explained, but some people misinterpret what he explains, and they still fail because they're taking the wrong 22 model that ICT would never take in his life, because he knows what's going to work and what's not going to work. Okay. Bro, what you need the body to come into the I'm confused. What do you mean? When we wick down here, I'm longing, okay? And it just happens to close as a wick. Okay. So it doesn't care. I don't care if a body comes. And then where'd my stop loss for this be? Yes, this is valid. Yes, this is very good during kill zones. Asia session, no idea. Okay, but kill zones for sure. Yeah, again, stop loss for this would be a close below. And there's two possible stop losses. If you want to be aggressive and have a smart stop loss, knowing you're probably right, and the price action's good, stop loss is a close below. If you're trying to be safer, stop loss is always below the last lower low. But if you're right, we probably won't close below this anyways. However, if price action is sloppy, sometimes you will close below and go back up. So if it's during kill zone, the majority of the time, if it's during kill zone and price action is pretty good, we don't have any upcoming news, we generally will not close below this. If it's during a sloppy time, sometimes we will and we'll go back up. So if it is sloppy price action, just loosen your stops and have your size. That's my recommendation. Okay, a lot of people don't know how to size, but that's a whole different story. Another way to look at it is that you're trading from where the manipulation zone starts. Yes, exactly. Yes, that's another good way to look at it. When I was new, I didn't understand, oh, this is manipulation, this is accumulation, this is a distribution. So I don't really like teaching that to new people, but what's caused my most losses when I backtested? When I backtested an FxReplay, my most losses is caused by me not being able to look at NQ and ES at the same time. If I cannot look at ES and NQ at the same time, I lose 10 times more. Okay, I win the most when I'm looking at both, because I know if they're correlated, I know if one's hit the high, I know if one hasn't. But when I'm backtesting an FxReplay and I cannot see NQ and ES combined, I take a lot more losses than if I could see them together. Okay, and that's the other. When I started ICT, I never used to look at them side by side. Now I'm always, every single day I do, because you have to. You just have to. It's not even just both pairs acting in correlation. It's both pairs. One could hit a high, meaning another long setup might not be good because what the other already hit the high. Yes, I make sure there's no S&Ps. I make sure they're kind of correlated. If not, that's not as high probability. And a lot of people don't know this, but ICT does trade YM occasionally. He just never shows his execution for it. Yeah, Mo, I do that all the time. Like, I'll in my live streams, I'll literally say, okay, just because ES hit the high, I'm gonna scale more than I usually would on NQ here, just in case NQ doesn't hit the high, stuff like that, and that's why my win rate's also so high. Okay. By the way, we will go down and hit this low, and then my last target's this low. Okay. Why do I think this? It's because we're delivering from a 4-hour BPR. Okay. So we're delivering from a 4-hour BPR. And then once we hit one of these, we got equal highs up here. So order flow right here in Euro USD is pretty bearish. So whether we go here or here, the next target would be these equal highs. What's an A+ setup for me? A+++++ setup is any setup that has perfect equal highs on the hourly or 4-hour and ES and NQ to the tick with an inverse model. That's my perfect A+++ setup. But generally, an A+ setup is just a sweep of like a previous day higher low, sweep of London higher low, okay, which will have no displacement below or above. Okay, so I want to see like London low displaced with almost no displacement, and then the inverse model off that. And I'll target the next high. If it's equal highs, makes it even better, but generally if it's a single high, it's still an A+ setup. But sometimes like a random low gets swept, like a 805 low. Maybe it's not previous day low, maybe it's not London low. So if like a random ass low, like a 1205 low, which is nothing, gets swept, and we get a long setup, that might be more of like an A- or B+ setup to me, just because it's not really a significant low, but it is a low and we didn't displace under it. So yeah, BPRs are more high probability. But inverse is also good too. Like they're both. Can I go over confirmation setup? Yeah, that's the last thing I'll go over. Like if NQ sweeps London high and we get a short setup, I'll take a short setup. If both sweep London high, that's even better. But if at least one sweeps London high and we get a short setup, I'll take it. Let me go to right now, actually. So a lot of people are saying, oh, there's just an inverse that offered. Okay, would I have taken the setup? Yes or no? Would I have taken this? Oops. So if you look at it closely, I probably wouldn't have taken this if it was a kill zone, because see how like the body holds here and we never actually inverse it, and then we get a short setup. So really, anyone who's shorting this is gambling. Okay, anyone shorting this is gambling in my eyes. Because we never really inversed it, did we? Okay, did we take out these low? Did we take out these highs? See how we like take out these highs, but we don't take out these highs? Okay, we know we're not going to take out these highs if we barely displace over these. So there's not really a lot of displacement up above these, so a short setup would be fine. If we went like this and then reversed, would I be really looking for a short? Probably not, because this is a lot more displacement. But like in hindsight, if you come back and you see this candle, like it would be okay. If we barely displace above these, it's fine to look for a short. Anyways, this setup right here, there was an entry. It just wasn't this. Okay, this was not the entry. However, this was the entry. Okay, we got an order block. This candle closed below. The retest of the order block combined with the inverse is your entry. Do you understand that? See how the inverse and the order block line up to the tick after we actually close below it? So this would actually be the entry, not this one right here. Right, this might be an entry with like a 60, 70% win rate. This is going to be an entry with like a 90, 100% win rate. So they're both entries, just one's going to have a higher probability. Yes, that's a beautiful one, GDT. That's good. And then you target that wick high. So, yeah, that's a good question. So he said, what about this? Would I short this if we came back up here right now? No, why would I not short this? Oh, you're already in this? So if we retrace back up here, I would not take it because we've taken so many lows here that it would not be worth it anymore. But if we did this and then we retraced up to it, okay, this is going to be very advanced. Oh, God. So I know people are going to leave after this because they're not going to understand this, but this is just how the market moves. I can't explain why, but this is just how the market moves. Okay, let me go in the replay mode and give a good explanation of it. But if we came up to this low without hitting this inefficiency, okay, yes, I would short it. I would short it. Okay, and a lot of people are like, oh, why do you short this? We're literally bouncing from maybe this is a 15-minute fair value gap right here. So yes, it's a 15-minute fair value gap, see? And a lot of people will be like, oh, why do you take this? Because we're bouncing from a 15-minute fair value gap. Yeah, but there's a nice low down here. We already violated the mean threshold of this order block. Even though we're in a 15-minute fair value gap, we already violated the mean threshold of this. So we're probably going to come back down here. This is still a 15-minute fair value gap, but now this is the 5-1. It's like a fractal setup. However, if we did this and then came back up to it, hell no, I'm not sure with that. Because now we're delivering from two things. We're delivering from a 15-minute bullish fair value gap, and we're delivering from a bearish fair value gap. So does this make sense? Why I would not short this, but I would short this. So I would short this. Okay, I'd short that, but I would not short this. It just a tick can change what I think. Just like literally a tick. Like if we did this, I would still not short it, but if we did this, I'd short it. I don't know. It's just that's how I have a high win rate, because I just make sure these conditions are true. Yeah, exactly, GDT. All right, well, I think that's gonna be it for now. Wait, Eli, is your friend still here? Let me just explain the confirmation setup real quick. Okay, confirmation setup is this. Let's say we have a bullish fair value gap you want to long, and it's on the 15-minute. I'm not longing this. I'm not gonna just buy. I'm not doing that. Okay, that's stupid. Okay, I am waiting for when we come to the 15-minute fair value gap. I am waiting for us to form like a second setup on the 1 minute. So now that I see we're in the 15-minute fair value gap, I'll wait for like a lower time frame setup. So maybe something like this. See how we have a singular inverse here? And I'll wait for this. Then this will be my confirmation setup, because now I have a way tighter stop loss, because I can now place my stop like under this inverse, versus if I long this 15-minute fair value gap in the middle man's land, my stop loss would be under here. Do you get that? Yes, the highs and lows are very important when evaluating that. Yes, understanding time fractals, which a lot of you guys are not going to understand, which is, yeah, I can't really, that's down the road. Alright, so if we look in live time right now, what do I see? Okay, we never inverse this, so there's no long setup. There's no confirmation long setup, but we had the condition there if we saw it. Now, alright, let's say we inverse this. Well, if we inverse that, I know we at least have to go to this high up here. So now I just draw this out, wait to see if this remains true, if we inverse it or not. If we do, I'll long to this high and then I'll hold higher. Easy, quick scalp. But if it's not inverse, we're just going to keep dumping down to this low, okay? but I'll set the condition based off of how we react to this fair value gap right here. So yeah. All right. Why not the other high? So here, wait. So I just disclaimer real quick. It is Asia session. If this is a New York kill zone, I know for a fact we'd have to hit this other high if this is inverse. But we know there's low volume. We know someone living in Pakistan in their mom's basement could literally reverse the market right now. So I still think we're gonna hit this high if this is inversed. But it's obviously Asia session, so it's not a guarantee. Versus New York, again, there could be. I just haven't backtested in Asia. Okay, so I'm not going to teach something I have no experience off of. Yes, is recording off this. Yes, a confirmation setup is a setup within a setup, and I do have a YouTube video about that. So, if I were you, I'd go on paper trading right now, and if we close above this, take a long, target this high, and put your stop loss. Because there are two inverse fair value gaps under here, I put a stop loss to close beneath this one. So it looks, this would be more of a 1-1, and this is why I don't like the, well, there's two, but this would still be, yeah, you could probably get a 1-1 out of this. I would stay on stream and do it, but I think I'm going to go play Minecraft now. So, if anyone has any questions, I'll probably be in the Minecraft voice chat, playing with a couple people. So, while I'm playing, you guys can bother me with questions if you want, but I'm not going to be able to show it on the chart. So, yeah, that's going to be it for now. Watch to see if this plays out. If we close above this, try to take a long at least on the side. If there's no close above, you do nothing. Okay, you do nothing. You do absolutely nothing. But yeah, that's going to be it for now. Hope you guys learned something, and peace out.